Does real estate income require HST registration? When a US business starts earning money from Canadian real estate, the question usually comes fast. Does this income require GST HST registration in Canada? The answer depends on the type of property, the nature of the rental or sale, and how much revenue you are earning. Residential rentals, commercial leases, short-term stays, and property sales each sit in different places under the GST HST rules. Understanding how these categories work will tell you whether your real estate income is simply subject to income tax and non-resident withholding, or whether you also need to step into the GST HST system and start collecting tax on top of rent or sale proceeds. Types of real estate income and GST HST. Real estate income generally shows up in three forms. There is rental income from long-term residential tenants, rental income from commercial tenants, and income from short-term stays such as vacation rentals or hotel-style accommodation. On top of that, there are one-time or occasional sales of real property. For GST HST, the dividing line is between exempt supplies, which do not attract GST HST and generally do not require registration, and taxable supplies, which either charge GST HST or contribute to the $30,000 small supplier threshold. Residential rental income. Most long-term residential rental income in Canada is exempt from GST HST. A typical example is a year-long lease of an apartment or house to an individual or family as their place of residence. That rent is usually exempt, which means you do not charge GST HST on the rent, and you normally cannot claim input tax credits on expenses related to that residential rental activity. Because exempt revenue does not count as taxable supplies, residential rental income on its own usually does not push you over the small supplier threshold or force GST HST registration. You may still have income tax and non-resident withholding obligations on that rental income, but that is a separate system from GST HST. Commercial rental income. Commercial real estate is a different story. Rent from office space, retail storefronts, warehouses, industrial units, or other commercial property is generally a taxable supply for GST HST purposes. That means you are expected to charge GST or HST on top of commercial rent once you are required to register. It also means that commercial rental revenue counts toward the $30,000 small supplier threshold. If your gross taxable rental revenue from Canadian commercial property reaches or exceeds $30,000 over a single quarter or over 4 consecutive quarters, you usually stop being a small supplier and have to register and start charging GST HST. At that point, you can generally claim input tax credits on GST HST paid on related expenses such as property management fees, repairs, and certain professional services. Short-term accommodations and platforms. Short-term rentals, including stays booked through platforms like Airbnb or similar digital accommodation platforms, can also be taxable for GST HST. Canada has tightened the rules in this area, including specific measures for platform operators and short-term accommodations with rental periods of less than a month. If a non-resident earns more than $30,000 in gross revenue from short-term accommodation supplied in Canada over a 12-month period, registration for GST HST is generally required for that activity, and tax has to be charged on the rental amounts. That is separate from the 25% non-resident income tax withholding that can apply to gross rental income. Real estate sales and GST HST. Sales of real property can also trigger GST HST obligations. The sale of most commercial real property is a taxable supply, although in many cases the purchaser, not the vendor, is responsible for accounting for the GST HST directly to CRA if the purchaser is registered. That does not mean the sale is outside the GST HST system. It just shifts who reports the tax. Sales of used residential housing are often exempt when sold by an individual, while sales of new or substantially renovated housing made by builders are generally taxable. The details can be complex, especially when non-residents sell Canadian property, because separate non-resident withholding and Section 116 clearance certificate rules may also apply on the income tax side. Non-resident real estate owners. For non-resident owners, the first layer of rules deals with non-resident income tax and withholding on gross rental income. That system applies whether or not you are registered for GST HST. In parallel, if your real estate activity involves taxable supplies such as commercial rent, short-term stays, or certain sales, and your revenue reaches the threshold, GST HST registration may become mandatory. In some cases, a non-resident may not technically be carrying on business in Canada, but may still be required to register because they make taxable supplies of real property in Canada and exceed the threshold. In other cases, commercial real estate activity is one part of a broader Canadian business that clearly triggers registration. How the $30,000 threshold fits in? The small supplier threshold is measured based on worldwide taxable supplies that are connected to Canada. For a non-resident real estate owner, that usually means looking at taxable commercial rent, short-term accommodation income, and taxable sales of real property. Exempt residential rent is ignored for this test. If your taxable real estate revenue in Canada exceeds $30,000 over a single calendar quarter or over 4 consecutive quarters, you are generally expected to register and start charging GST HST. You may also choose to register voluntarily earlier, particularly if you have significant GST HST on property-related expenses that you want to recover through input tax credits. Final thoughts. Real estate income does not automatically require HST registration, but certain types of income make registration almost inevitable once they reach scale. Long-term residential rent is usually exempt and sits outside the GST HST system. Commercial rental income, many short-term stays, and sales of commercial real property are taxable supplies that can push you over the $30,000 threshold and into mandatory registration. If you own or are planning to acquire Canadian real estate as a U.S. business, the right approach is to map each revenue stream to its GST HST status and watch your taxable revenue levels. That way, you know if and when real estate income transforms from a straightforward rental or sale into a full GST HST compliance obligation. If you want more plain language guidance on Canadian GST HST for real estate, including non-resident ownership structures, you can explore our website for additional resources. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.